As asset managers, we are very concerned about the oil crisis. It goes without saying that the biggest cost is human life, but the economic cost is potentially quite substantial, and the effect on financial markets globally and in South Africa is very substantial as well. It's significant. It's probably the worst oil supply crisis that we've had since the first Gulf War in 1991. The greatest similarity, and we've done a huge amount of research on this, it's not the first oil crisis that we've had. We've had other oil crises, 1973, 1979, and incidentally the 1979 crisis was also related to Iran when the Shah was overthrown in the revolution. And more recently we had the oil crisis when Russia invaded Ukraine in 2022. So if we stretch back to try and find a parallel, the global economy going into the crisis was incredibly strong. And that was really because of huge fiscal and monetary stimulus. The last similar crisis was, in fact, that first Gulf War in 1991, when the Fed was cutting interest rates, other central banks around the world were also cutting interest rates. And as a result, when the Gulf War was resolved, the equity markets around the world rebounded incredibly strongly. So one has to be very careful about taking avoiding action in these markets, because a rebound could occur this time around as well. It's very similar. The oil crisis itself, of course, is a result of America's war on Iran. It's a very asymmetric war, and even though the Iranians are completely dominated by American air superiority, they are able to cause disruption in the Strait of Hormuz. So 20% of all global oil comes through the Strait of Hormuz. And that is why the oil price has rocketed, and fuel prices at the petrol tanks has gone up. So that's something that we're all familiar with. You hear nightmare stories of airfare prices. That's definitely not our first rodeo. If we start off with the biggest economy in the world at the moment, the US produces 24 million barrels per day, and it only consumes 21 million barrels per day. So the US economy is actually very robust despite the oil crisis. And then we've got countries that are net importers of oil, and to make matters even worse, countries that rely very much on Middle Eastern oil that comes through the Strait of Hormuz. So 80 to 90% of the oil that goes through that critical passage ends up in the Far East. So the Far Eastern economies, most of them, there are a couple of exceptions like Malaysia that produces oil, Indonesia, but other countries, China, Japan, and so forth, Taiwan, Korea, they import all their oil. So they've got very large, what's known as net oil trade deficits. And Europe as well imports all of its oil, and it's particularly vulnerable to the LNG market. So Qatar produces a huge quantity of the world's LNG, and all of it goes through the Strait of Hormuz. We've seen Iranian missiles destroying a good part of Qatar's natural gas fields, and Europe imports most of that. So Europe is badly affected, and the Far Eastern economies. The last time we had an LNG crisis was in the 2022 invasion of Ukraine, and Europe, as we know, suffered the most with that invasion. South Africa imports a lot of oil that comes through that Strait of Hormuz, and I believe it's between 40 and 60% of all of South Africa's oil imports comes from that source. And South Africa doesn't produce its own oil. We've spoken about fracking in the Karoo, and there is offshore oil in Mossel Bay and off the coast of Namibia, but none of it has been fully exploited. So we depend entirely on imported oil, and we have a large net oil trade deficit. It's around 2%. It's one of the highest in the world. So we are badly affected. What happens to the South African economy when the oil price goes up? Inflation goes up. So we had expected inflation to reduce down towards the 3% South African Reserve Bank target. As a result of the higher oil price, it's probably going to end up above 4%. What does that mean? Of course, household disposable income gets impacted by that, and it means that the South African Reserve Bank, which had been expected to cut interest rates, the repo rate, by 3 installments of 25 basis points this year, will have to put those monetary easing plans on hold. So it's an effect on household disposable income, consumer confidence, the cost of businesses goes up, logistical supply chains, manufacturing plants, the mines that rely heavily on fuel consumption to extract and process ore, the cost of production will go up a lot. So South Africa is really in the same boat as the Far East, as Europe, as being one of the most heavily impacted economies worldwide as a result of this crisis. Portfolios were structured with this particular risk in mind. So we have very well diversified portfolios. We have asset classes that perform very well when this eventuality arises. So we'll start off with the local portfolios. We have a considerable exposure to rand hedge asset classes and foreign exchange traded funds, ETFs, and those tend to perform very well when there's a crisis like this. When a crisis like this occurs, the first thing to happen is that the rand appreciates. So all those foreign listed ETFs do incredibly well, and they compensate for the underperformance of the other parts of the portfolio. With the global portfolios, we have a lot of exposure to traditionally defensive asset classes, high-yielding bond funds, credit funds, hedge fund strategies that are negatively correlated to the direction of equity markets. The only thing that we have done is a little bit of spring cleaning. If there are 1 or 2 shares that we weren't that excited about, or there were some concerns, we took the advantage to get out of those and recycle. The one instance in the global portfolios, we trimmed the exposure to software as a service private equity holding called HG Capital, and we sold that and went into a defense stock. So there's an ETF called Van Eck Defense, and it specializes in high technology defense. And the exciting thing about this is that over the next 10 years, the budget allocation across the world in different countries to defense is going to increase as a percentage of GDP. It's not just a knee-jerk reaction, it's a holding that we intend keeping in the portfolios for a long period of time. And this conflict has really been the catalyst for increasing that exposure. Our very qualified wealth managers will reassure our clients that we have well-structured portfolios prepared for this eventuality. I think the other thing, we were very positive on the global economy going into this conflict, and coming out of it, the world economy could be even stronger. We're still going to have the fiscal stimulus, monetary stimulus. We will have, for instance, the big, beautiful Bill Act in the US, huge stimulus in Europe, a lot of stimulus coming through in Japan, and very easy monetary settings. Global trade is increasing despite all the tariffs last year. And on top of all of this, we're going to have the extra stimulus of fixing all the infrastructure that has been damaged in the Middle East. So coming out of this conflict, the world economy is going to be even stronger than it was going into the conflict. So we've got to be very prepared to use the opportunity of buying into those markets that have been worst affected, like the Far East, like South Africa, like Europe, Japan, and those economies and markets will probably benefit the most when we get that post-conflict rebound. We see this more as an opportunity rather than something to be afraid of from purely an asset management perspective.